first company presenting is Palace Capital. We're fortunate to have with us today Neil Sinclair, the CEO, and Stephen Sylvester, the Finance Director. Palace Capital are experts in regional property investment, and they aim to unlock value through better asset management to deliver attractive total returns to shareholders. Last week I watched an interview that Neil gave to Sky TV just days before the general election last December, where he pointed out just how different conditions are in the north of England compared to London and the south. And we've obviously, since the general election, seen a rebalancing in government policy, we're only at the very beginning of that, towards the old, what were called red wall Labour seats. And Palace Capital is very directly exposed to that. And then earlier this week, the company announced a really pleasing set of final results. So without further ado, let's go to Neil. Neil, over to you.
Good afternoon, everybody. Thank you for joining us. This is a very momentous day for me because I had my hair cut an hour ago. So that I can tell you. So we are experts in regional property. We work on the basis of total return and we unlock value by doing that. So regional returns have outperformed London over the past 4 years. Our portfolio is mainly made up of offices, just under 50%. We've got about 14% in industrial, and offices is one of the strongest risk-adjusted sectors in the UK. The reason we invest in the regions is, one, there's been limited development. Secondly, there's been what's called permitted development, which is the loss of office space to residential. And thirdly, you've got the government's levelling up agenda where they're focusing on regenerating the Midlands and the North. And we feel we are well placed to take advantage of that. And already we're hearing about certain government departments that intend to move to the north of England. So this is our regional portfolio. We have 53 properties. We have 204 tenants. Our top 20 represent 42% of our portfolio. Our finance director, Stephen, will tell you that of our top 20 tenants, 19 are up to date with their rent. And a lot of our compatriots have been struggling with rent collection. We've had a very strong rent collection from March to June, and June to September is already looking particularly strong. We operate on three areas we call Core Plus, which is our property investment and our income. Then we have our development, and we'll talk about what's called Hudson Quarter in York in a minute. And 32.7% are properties which we buy where we can add value through refurbishment or redevelopment. So the Northern Powerhouse you've all heard of, we are very well placed with the Northern Powerhouse. We have significant holdings in Liverpool, Manchester, Leeds, Newcastle. We're building in York. Up until last Friday, we had an investment in Sheffield, but we actually sold that. We're great believers in recycling our money, but we're very well placed in the north of England. You probably know, besides HS2, they are planning a high-speed rail between Manchester and Leeds. So how do we deliver value? So Hudson Quarter is what we've called our development, which is situated approximately 1 minute's walk from York Station. This was a 100,000 square foot old British Rail office building, 80% empty when we bought it. We bought it from Quintain. It was valued in 2013 at 3.8 million. We went through the planning process, and by September 17, we achieved the planning consent that we wanted, and it was valued at 16 million. This is how we create our value. We then had to take a decision. Do we sell it or do we do it? And we took the view the right thing to do was to really make money here, was to develop it. And we estimate that our gross development value from this development will achieve at least a 10 million surplus and a 20 million pound cash on cash return. It's fully funded by Barclays Bank. We've already sold 32 apartments valued at 8.5 million. 5 were under offer when we presented this presentation. We've agreed 2 more for 500,000 in the last 48 hours. The Marketing is going full speed at the moment. It was very quiet, to be quite frank, until about 2 weeks ago, but it's picked up very significantly, and even more so yesterday afternoon and this morning with the Chancellor's statement on stamp duty. We are very confident we are going to sell most of these by the time it's completed in March 21. And we've also got an office building there of 35,000 square feet of the highest quality. York has the fastest connection to the north from London in an hour and 50 minutes. And we are very confident that we will let that building. And we expect to complete this property in March of next year. One thing I would mention, there's been a lot of talk about the future of the office. We are very clear about that. We think the office has a future, but people will look at cost. And the great thing about regional offices is that the rents are modest compared to London. And we think in the next 2 or 3 years, both the public and private sector are going to look at their overhead, and they're able to go to York at £25 a foot instead of being in London at approaching £100 a foot. So we also create value by refurbishing buildings. This is what we call value add. This is the entrance in our building in Newcastle, which we bought for £20 million 3 years ago. The rents in those buildings, this building was just under £18 when we bought it. We're now getting over £21. We did a recent letting to the National Lottery, who are in there. We're refurbishing 2 floors, both the 3rd and the 7th. The great thing about Newcastle is what we're hearing is that this figures very much in the government's levelling up agenda. There are already requirements for Newcastle from the public sector. They're already getting round the corner to our building over £24 a foot. And on a new building, which the Legal and General are developing, they've agreed to let a good slug of that at £26 a foot to the government. So we think this particular building will show considerable growth. I'll now pass you over to Stephen.
Thanks, Neil. So if you're investing in real estate at this point in time, you'll be very aware that rent collection has become the #1 thing talked about. COVID-19 has brought to prominence rent collection. As Neil said, our rent collection has gone extremely well. March quarter, we've now collected 93%, and June quarter, which runs through to September, we're up to 84%. Clearly, that 16% that's uncollected and outstanding is it takes our attention, and we're still looking to bring that down. But in the circumstances, we are extremely pleased. We're well ahead of our peer group in terms of rent collection, and a lot of that really has been down to the way that we manage our properties. Although we outsource to managing agents, rent collection and facilities management, in this instance, we took it upon ourselves, and internally our asset managers spoke to every single tenant. We have 200 tenants across our portfolio, and although it's been painstaking, it's important that we actually understand what are the key drivers with our tenants. And as I say, we've come out in very well from these last 2 quarters. One of the reasons we've just announced our year-end results this week, and one of the reasons we delayed it a month was because we wanted our June rent collection stats before we reinstated dividends. Here's our financial track record. Clearly, the portfolio has grown over the last 5 years. We tend to gear our properties, and our comfort level is around 30 to 40%. That's the bracket that we tend to operate in. You'll notice loan to values increased to 38%, which is fine for now. We will look to see that reduce. And as Neil mentioned, Hudson Quarter, which is a major development for us in York, is due to complete next year. So we'll see that loan to value drop back down towards 30% off the back of that completion. I will just mention here, in terms of property return, we have outperformed the benchmark now for 3 years running. And although our return has fallen over the last couple of years, clearly it's market driven, but the important thing is how we perform relative to our peers. And as I say, we've outperformed our peer group. The chart to the right just shows our cumulative dividends paid. We have been paying at a rate of 4.75p per quarter up until COVID. And at that point, we decided to cancel our Q3 dividend, which was payable in April, in order to preserve our liquidity while we saw the crisis play out. And as I say, we waited for our rent collection, and off the back of very strong rent collection, we've reinstated our dividend. We're paying 2.5p out next month, and that will be a minimum level that we look to pay each quarter going forwards. Important just to note where we're at in terms of our share price. When we kicked off back in 2013, we were at 200p. You can see shareholder return has been positive right up until the point of COVID. Unfortunately, it's had a big impact on our share price, and the chart to the right will show you that we've been impacted more than the average within our sector. We obviously think that that the market has not fully understood our situation, and actually our results coming through this week will hopefully have given lots of comfort around where we're at as a business. So just in summary, our rent collection held up extremely well in response to COVID lockdown. We hold the right assets in the right locations, and we believe we're focused with office and industrial in the right sectors. We've got income reversion within our portfolio. We refurbish space, and we're looking to grow our income organically. We also have capital growth opportunities. We've got a major development in York where we expect to see £10 million development profit come to fruition next year. We've got a medium-term development pipeline. We are a REIT. We converted to REIT status last year, and it's already proven an efficient capital structure. So we're well established. We've got a platform. We have a portfolio which is focused on the regions, and we believe is in the right place to capitalise on the government levelling up agenda. And we've come out the other side in terms of our rent collection, and we believe that we are well placed for the future. Thank you very much.
So now we are going to go to questions. I've got a number of questions about specific locations, so I'm going to try, in the interest of time, to roll this into one basic question. There are three properties that have, or three assets that have come up for discussion. One is the residential-led development in Surrey, which I think is Weybridge.
Yes.
The next one is Manchester, and I'll ask you a specific question on Manchester in a minute. And then also we've had a question about what happened in Sheffield. So I'm going to start with Sheffield and then go backwards. Can you tell us more about the Sheffield disposal? What was the thought process behind the sale, and how do the proceeds compare to book value?
Right. So I'll answer the third part first. So that property was part of a portfolio that we bought off Quintain 7 years ago. And you know, when you buy 24 properties, there's always a few which we call dogs that you get lumbered with. You know, is this part of buying company? And these were a group of little office buildings near the Meadowhall shopping centre. It was never going to go anywhere. It's never shown any growth. And slowly but surely, we've sold off the buildings over the years. But we still had quite a bit left over. And last Friday, we sold it for £1.25 million. To somebody who actually agreed the deal on Monday and signed on Friday. The book value was 960. He offered £1.25 million. We wanted a little bit more. We said, well, we'll take that, but you've got to sign by Friday. And he did. And the good thing about that is it was not charged, so we get all the money. And we lose very limited income. Most of it was vacant. So that's one of the things we sold. The other two we asked about was Weybridge. Weybridge, we've got consent for 28 apartments. What we've done there is we've asked Savills, who are our agents on that, to give us a revised assessment as to the market post-COVID. They've initially told us that the market in Weybridge, because it's one of a very prosperous town, is still very strong. So we're looking at that. and we will make a decision probably in September as to whether we sell the site or whether we do it ourselves. One or the other, we're not sure. We don't have any money in it, it's uncharged. So all we've got to do is do the construction. That is all. And then finally, there was a question on Manchester, was there?
Yes, I'll give you the precise question on Manchester, if I may. If it's such a strong location, why do you not have higher rents per square foot? Maybe you could put that in context for people.
Right, so it's a good question. So Manchester is a very strong location, but this building is a 70s building. And it's not 20 years old. When we bought it, we were getting 12 to 13 pounds a foot. We took it as an opportunity for two reasons. One, it's got very good site coverage, and the building is 75,000 feet, is not big enough for the site, frankly. It's got potential for at least 150,000 square feet on the site. But the space is what I call 70 space. We've refurbished it the best we can. And that type of space gets up to about 18, 19 pounds, which is what we're getting. But the fact is, when we bought it, the rents were 12 to 13. So we've actually seen a 50% growth in rent. And we've also seen a 50% growth in value.
Okay, I've now got a more shareholder-led question, which is, what has happened to your shareholder register while the stock has dropped during the coronavirus? Have you seen much movement in the register, or is it basically a liquidity-driven fall?
I think liquidity is part of it, but the whole question with the shareholder register is that you have the shareholders listed on our website, but that's not the true situation, because they are the shareholdings as they've been disclosed to us. And as you know, if they don't disclose them to us, we can't technically say what they've got. But a number of our shareholders have increased their holding. AXA are over 10%. You probably saw last Friday that Allianz increased their holding, and they're now over 5%. Unicorn have increased their holding, and Henderson's have increased theirs. So most of our shareholders during this time have actually topped up their holding because they see the shares as good value.
Right, the next question is on LTV, so I'm going to combine two questions. You don't seem to have much headroom on LTV. How do you get around this? And what happens if values fall? If values fall, the LTV will obviously rise, but how do you address that whole equation?
Yeah, good question. The loan to value is certainly a covenant with the banks. I could have touched on this earlier, actually, that as a result of the challenges with rent collection, banks generally, they have a cover test called interest cover ratio. Those tests have been under pressure at this time. Loan to values haven't been so much. I think the reality is, if there is a downturn in the economy, your loan to values are then under more pressure. Now, we've always taken a view to keep loan to value at a conservative level. It is around 38% as we speak. And if values fell, then clearly loan to value would increase. I think that's where we've got, with York coming to completion next year, we've got a big chunk of cash coming in the door. Plus there's some disposals. We've got a disposal strategy where we're recycling some capital out of assets where we've maximized values. So yeah, it is absolutely, it's important to monitor that we do have headroom on. I mean, we've got loan to value covenants across our various facilities. We do have headroom, but it's always worth being very cautious when it comes to how far you gear your properties.
I think we should say, if I may, very quickly, that if Hudson Quarter goes according to how we see it going at the moment, then we see the loan to value dropping into the low 30s.
So what percentage of the asking price are you getting on the apartment sales in Hudson Quarter?
100%.
100%. Okay. I've got two more general questions, and I think then we're almost going to be out of time. The next question relates to retail park footfall and your general comments as to what you're seeing and how quickly you think things might recover in terms of footfall.
Well, retail, we are seeing a slow recovery, but we're not a company that ideally invests in retail. We've acquired retail through the portfolio acquisitions we've made when the retail's been part of what we've bought. Now, the good thing is that, for example, we've only got 2 retail warehouses, but we've got Booker as one tenant, which is Tesco, and the other one is Wickes and Pets at Home. So they've all been open all the time, number one. Wickes is in East Grinstead is one of their best performing ones, according to Travis Perkins. So in consequence, we're quite happy with those, and they've had reasonable footfall, even during the lockdown, funnily enough. But in terms of retail itself, we have very limited retail. We've got a supermarket let to Aldi, and that, of course, has been open ever since the lockdown. And the rest is all small shops. So we don't really focus in that particular sector. And even our rental collection figures on the retail side are really good at the moment.
Thank you very much. Well, I've got more than one question left, but in the interest of time, I'm going to ask you this final question. Are the directors topping up at these lower levels of stock price or not?
Very good question. That is definitely under review.
Thank you very much.